Having enough money pouring in passively to cover life's expenses is what it means to be financially free. You can consider yourself financially free once your everyday costs are covered without the need to work. If you've been watching the channel for a while, you're aware that in order to achieve financial independence, we must buy assets that provide sufficient income to support our lifestyle. What assets, on the other hand, can offer us with not only cash flow to cover our living expenditures, but also protection from market downturns and inflation. So now, let's look at 7 items that will help you quit your work. The first is cash flowing real estate. Real estate is believed to be one of the finest ways to build money, and for good reason. For one thing, real estate tends to appreciate in value over time. The median home price in the United States was $97,000 at the start of the 1990s, according to historical data. Today, the average home is worth more than $342,000. In the last 30 years, the market's worth has more than tripled. Second, a person can hold this form of asset without having the financial means to do so. Let's assume we buy a house for $200,000 and put down $40,000 as a down payment, then finance the remaining $160,000. Expenses, including mortgage payments, interest, insurance, and taxes, will total $830 per month over the following 30 years at a 2.5% interest rate. This means that we can own a $200,000 asset for $40,000, or in many circumstances, much less. But suppose we could rent this residence for $1,200 per month. After expenses, we have a positive cash flow of $370 per month, or $4,440 per year. The beautiful thing about real estate is that it allows you to generate equity by having someone else pay for your asset. Year after year, the value of your house rises, and you enjoy positive cash flow month after month. Not to mention the various financial tactics that can be employed to increase one's wealth through real estate. Many investors exploit the appreciation in their properties value to borrow money to buy new properties. Let's imagine your $200,000 home has appreciated in value and is now worth $250,000. So you refinance this house and take $50,000 out in cash, then utilize that $50,000 to purchase another $200,000 property. This means you were able to buy $450,000 worth of growing real estate with your original $40,000 investment, effectively doubling your cash flow because you now have 2 properties generating income every month, not to mention the tax benefits that come with owning real estate. But that's a topic for another video. Stocks that pay dividends are number 2. Owning stocks of extremely profitable firms that pay dividends to their owners is one of the simplest methods to start generating passive income flow. Dividend yields differ from one company to the next. Apple, for example, pays a dividend yield of 0.57%, while ExxonMobil pays a dividend yield of 5.3%. A dividend yield simply refers to the percentage of the stock's value that is paid out as a dividend. A $100 stock with a 3% dividend yield will pay you $3 per year for each share you hold. However, dividend yields are only one factor to consider when buying a company. We must invest in financially stable firms with a strong financial history and a promising future. AT&T, for example, offers a dividend yield of 8.3%, which is significantly higher than the market average. However, the company has lost about 33% of its value in the previous 5 years, making dividends an important aspect of our long-term cash flow strategy unless you have a lot of money to invest. Consider the following scenario. Your investment portfolio has an average dividend yield of 3%. So, in order to earn $1,000 per month in dividends, we'll need a $400,000 portfolio. This is why most people consider dividend investing to be a long-term strategy. Many investors use compounding interest and dividend reinvestment to build their portfolios to the point where they generate significant cash flow. This is, however, a long-term strategy. This form of income is relatively passive and is taxed at a lower rate than ordinary income, so it's a terrific addition to our cash flow. Normally, investors in public firms have little power over how much of the company's profits are distributed to them. You might enjoy the next asset if you desire more control over how cash flow is dispersed. The third category is cash flowing enterprises. There are a lot of profitable companies that aren't listed on the New York Stock Exchange. These can be actual enterprises, such as a restaurant, coffee shop, franchise, or ATM machine chain, or they can be virtual, such as an app or software company. The goal is to own the company but not to run it. A business is not for everyone. To run a business successfully, You need a very specialized set of talents. However, many people own businesses, but instead of running them, hire employees to run them for them in exchange for a fair income or interest in the company. Now, compared to other types of investing, this type of asset has a higher level of difficulty. This could entail either founding a business from the ground up and working until it is self-sufficient, locating firms in need of an investor or a partner, or purchasing an existing business or franchise. Although this asset has a higher level of difficulty, it can provide a number of advantages, such as cash flow control. You have control over how much of the company's profits you can take home when you own it. You also have various tax advantages as a business owner, such as taking advantage of the dividend distribution tax, which is often lower than regular income tax. When you own a business, you can spend some of the money before paying taxes if it benefits the company. For example, if you have a multi-location firm, you can purchase a great car as a work car that allows you to visit all of your different locations. You can buy or lease it with pre-tax money because it's a business car. Naturally, you should obtain expert counsel to determine what you may and cannot do with your pre-tax funds. Now that we discussed how to build cash flow, let's speak about how to preserve your wealth against forces that aim to devalue it, such as inflation and market crashes. Gold, number 4. Many sophisticated investors, such as Ray Dalio, have a smaller portion of their investment portfolios in commodities like gold as a hedge against inflation and to devalue assets when markets fall, as well as the Dalio All-Weather Portfolio, which contains a strategy that allows money to grow in any economic condition. As a layer of inflation protection, Dalio invests 7.5% of his total assets in gold. Gold can provide value stability in a world where currencies are devaluing. Gold tends to rise in value when the value of the dollar falls, providing the owner with protection or a hedge against the dollar's depreciation. Bonds are number 5. Bonds are regarded as poor investments in today's world since they do not provide the best returns and in some cases do not even beat inflation. However, there are tactics that may be utilized to protect against market downturns with bonds, particularly for those who are nearing or in retirement. Warren Buffett, the famed investor, stated that if he died before his wife, he would order his manager to leave the money in a very particular yet very basic portfolio for her. Buffett advised investing 90% of the money in simple index funds such as the S&P 500 and 10% in bonds. Your finance professor had your Estrada test this method with previous market data to see how effective it was. And, to many people's astonishment, this basic technique outperforms expert retirement investing advice. However, Estrada added a twist to this method in order to fully utilize the safeguards that bonds might provide in an investment portfolio. No one can forecast when the market will crash, as you can see. We just know it'll happen sooner or later. So if we are already financially independent and living off our investments, we must have a plan in place. Keep a watch on the market once someone has retired and is withdrawing money from their investment portfolio. If the market is performing well, move your money to the equity side, which is delivering the highest profits. However, if the market is performing poorly and losing money, move your money to the bond side, as bonds tend to appreciate in value during bad markets. Instead of selling equities while they are down in value, this will give them time to rebound. Cryptocurrencies are number 6. It is impossible to overlook the impact that cryptocurrencies have on the world now, as well as their future potential. The whole point of cryptocurrencies is to create a global decentralized currency. Many people regard some cryptocurrencies as digital gold because, unlike fiat currencies such as the dollar, which can be readily manipulated by governments to generate inflation, many cryptocurrencies, such as Bitcoin, have a finite number of units accessible. This could someday allow cryptocurrencies like Bitcoin or Ethereum to operate as a sort of inflation protection, as well as be used as a transactional currency in the future, which is presently not the case. The one drawback of cryptocurrencies is that many people are purchasing as a means of becoming wealthy, which has resulted in many people making large profits. However, this implies that Bitcoin prices are insecure and subject to extreme volatility. This form of asset, on the other hand, can provide not only a buffer against inflation, but also prospective growth. Startups and growing companies are number 7. How many of you have ever considered what might have happened if you had invested in Amazon 20 years ago? What is the amount of money I would have now? What if I was able to get in early on Uber or Netflix? We can't go back in time and invest in those excellent enterprises, unfortunately. On the plus side, new businesses are founded every day that will someday be successful. These investments have the potential to yield a huge profit, but they also carry a huge risk. Those that invest in these enterprises typically commit a modest amount of their capital to these investments and are aware that these investments are likely to fail. However, if they invest in the proper company, their wealth can surge, propelling them to entirely new heights of wealth. These are all excellent investments. The finest investment, though, is in one's own education. For people who are well educated, real estate can be a lucrative investment. However, for those who aren't, it could be disastrous. Investing in stocks can be a fantastic strategy to develop long-term wealth. However, we may miss out on tremendous chances if we lack financial literacy. The cornerstone of investing and constructing the life we want is investing in our own knowledge. This is one of the reasons I enjoy reading books. They deliver years of learning in just a few hours. I appreciate your time watching, and I hope to see you in the next video.